Ready to pass the CPA exam faster? Visit cpapass.ai. Today, FAR practice questions, long-term contracts, and revenue timing. And let's start with a classic FAR exam problem. On January 1st, a gym receives $1,200 cash for a 12-month membership. How much revenue should this gym recognize for the month of January? Many candidates fall into the trap of recognizing all $1,200 immediately because cash was received. But under the applicable standard ASC 606, we must look at when the performance obligation is satisfied. Since the gym provides access over 12 months, the obligation is satisfied over time. Let's break down how to calculate the correct monthly revenue using the 5-step model. To solve this, we apply the 5-step revenue model. Step 1, we have a valid contract with the customer. Step 2, we identify a single performance obligation, which is providing gym access. Step 3, the transaction price is $1,200. Step 4, since there is only one obligation, we allocate the entire $1,200 to it. Step 5, we recognize revenue as the obligation is satisfied. Because the customer consumes the benefits over time, we recognize revenue gradually. $1,200 divided by 12 months equals $100 of recognized revenue for January. And let's look at the journal entries, which are highly tested on the FAR section. On January 1st, when cash is received before the service is performed, we debit cash for $1,200 and credit deferred revenue, a contract liability, for $1,200. Then, on January 31st, after 1 month of service has been provided, we adjust the books. We debit deferred revenue for $100 to reduce our liability, and we credit revenue for $100. This ensures our income statement reflects only what was actually earned during the period. Now, let's look at a more complex scenario. Multiple performance obligations. Suppose a tech company sells a software license bundled with 1 year of support for $1,200. The standalone prices are $900 for the software and $300 for support. Examiners love to trap you by splitting this price equally. Do not do that. Always allocate based on relative standalone selling prices. Here, the software represents 75% of the total standalone value, so we allocate $900 to it. The support gets 25% or $300. Once allocated, how do we recognize this revenue? The software license is recognized at a point in time when control transfers upon delivery. So we recognize $900 immediately. The customer support, however, is recognized over time because the customer consumes the benefit over the 12-month period. That means we recognize $25 each month. After month 1, total recognized revenue is $925. Remember, control is the magic word. Always ask yourself if the customer has gained control of the asset before you record any revenue on your financial statements. To wrap up, remember these critical rules for the FAIR exam. First, control equals revenue. Never recognize revenue just because cash was received. Cash received in advance is a contract liability. Second, when dealing with bundled contracts, always allocate the transaction price proportionally based on relative standalone selling prices. Never split them equally. Master these calculations and avoid these common examiner traps to secure easy points on your exam. For more practice questions, task-based simulations, and mock exams on ASC 606, head over to cpapass.ai and keep pushing forward.